Hey everyone, welcome back to Corporate Decoder. Today we're diving into Coca-Cola FEMSA's annual report. It's a bubbly business, but are their financials as refreshing as an ice-cold Coke on a hot day? We'll find out if they're pouring profits or just fizzling out. This report was officially filed with the Securities and Exchange Commission, that's the SEC, this April. Think of it as the company's official homework, letting investors know how they did last year. This report covers the entire year ending on December 31, 2024. This gives us a complete picture of their performance over those 12 months. Coca-Cola FEMSA trades under the ticker symbol KOF on the New York Stock Exchange. This makes it easier for investors in the US to buy and sell their shares, giving them access to a global brand. For those of you trading on the New York Stock Exchange, keep an eye on the KOF ticker. Each of these American depository shares, or ADSs, represents 10 units of Coca-Cola FEMSA shares. So if you buy one ADS, you're essentially investing in 10 slices of the company. And yes, Coca-Cola FEMSA is a well-known seasoned issuer. What that means is that this company has been around the block in the investment world and is known to most investors. All right, let's get into what this report covers. There is a lot of useful information here, so let's try to distill it and focus on the story. For those interested in dividends, Coca-Cola FEMSA has a history of paying them out. Dividends are like little bonuses or profit share a company gives back to its investors. For example, in 2023, they paid out 1.52 Mexican pesos per unit each quarter. That number changes, so the stock is not particularly stable with its dividends. But not everything is always fizzy and fantastic, right? Here they outline the risk factors. It's smart to really pay attention to these as it gives you an idea of what the company is most concerned about. One of the biggest risks, their close relationship with the Coca-Cola company itself. Almost all of their sales come from Coca-Cola trademark beverages, meaning if something goes south with that partnership, things could get rough. Another big worry is competition. The beverage industry is a crowded space with everyone from Pepsi to local brands fighting for shelf space and customer attention. This is very standard for any large business, however. They're not just battling competitors, they're also at the mercy of Mother Nature. Bad weather and natural disasters can disrupt their ability to make and sell drinks, affecting their bottom line. With the climate changing and weather patterns becoming more erratic, this is an increasing concern. This is a key point for you. The company says there were some slip-ups in their computer system or IT general controls. They had problems with user access and change management. This did not impact their reports, which is important, but it's something to keep an eye on. Let's get into the meat of it. How did Coca-Cola FEMSA actually do? Let's review what the team is saying. A whopping 75.1% of their total revenues come from Mexico and Brazil. So if the economies in those countries stumble, Coca-Cola FEMSA feels the impact. This really highlights their reliance on these two specific regions. Sales volume measures how much product they are selling. Sparkling beverage sales, which represent the core product for the company, increased, but only by 4.3%. Not bad, but not amazing. Prices for raw materials are rising, particularly things they get in US dollars. These could make drinks more expensive to produce and hurt profits if they can't raise the prices. Their strategy moving forward seems to be focusing on acquiring other companies for growth, which can be risky and depends on how well they manage. Let's jump over and see if we can find any details to those numbers. This table divides results into the Mexico, Central America, and South America regions. Here we get to see total revenues for Mexico, and Central America was 166,996 million. South America was significantly less with only 112,797 million. This table highlights some issues, specifically PET resin, which is a major packaging cost, went up in local currency across all their territories. That means that things got more expensive. Let's review the executive structure of the company. The chairman is Jose Antonio Vicente Fernandez Carbajal. He has been around for a while and also serves as executive chairman of FEMSA. There is a lot of other management listed here, but we don't have the time to go over them all. Here you can see the rules they follow to ensure the company is run in a fair and balanced manner. A lot of this is technical, but it gives you confidence that there are rules in place to try to keep people honest. We also learned they have a code of ethics. The company makes it clear in this filing that it takes ethical considerations seriously. Peaches as a stock from the bonus plan can increase demand, driving up prices. This benefits investors, but more directly, it's part of their compensation package. A more recent worry, like pretty much all public companies, KOF now needs to start describing their plans for cybersecurity. They work with third party to help with this, which can increase costs, but it also, more importantly, might not be enough to prevent attacks. Now, taking a step back, Coca-Cola FEMSA appears to be navigating a complex landscape reasonably well. Revenue growth is solid, but they're facing pressure from rising costs and economic challenges in key markets like Mexico and Brazil. The ongoing IT weaknesses they identified is definitely something to keep an eye on moving forward. Their focus on acquisitions for future expansion does carry risk, and I am wondering about the increasing debt they mentioned. They face real and tangible risks that can impact their operations in ways other companies don't have to worry about, such as weather and local conflicts in South America. This increases operational risks as well. Is it a good investment? Right now, I'm not entirely convinced. The increasing debt, combined with external risks and governance concerns, give me pause. It would be wise to wait to see more stability in their margins and ensure that remediation for the mentioned IT weak point is actually effective before adding to your portfolio. Thanks for tuning in to Corporate Decoder. If you found this breakdown helpful, don't forget to like, comment and subscribe for more in-depth analysis. Let me know in the comments if you would like to see a follow-up to this in the future.